Let's start with the number that matters. More than $4 billion of short positions were liquidated across the crypto market during this week's rally. To put that in perspective, on the 20th of August alone, over $2.74 billion of shorts were wiped out in 24 hours, and at one point more than $1 billion disappeared in a single hour. Bitcoin crossed $70,000 for the first time since June, while Ethereum broke above $2,100, a level it had not seen since May. This was not a gentle drift higher. It was a violent, forced unwind that crushed traders who had bet against the market. The result is that today, on Sunday the 23rd of August 2026, the crypto landscape looks dramatically different from just 7 days ago. The question is whether this is the start of something durable or simply a leverage-driven spike built on panic buying. The trigger came from an unexpected place, the US Treasury. On the 19th of August, the Treasury announced it would double long-duration debt buybacks. That pushed bond yields lower and ignited a broad risk-on move across financial markets. Lower yields make holding non-yielding assets like Bitcoin and Ether more attractive relative to government bonds, and they signal looser financial conditions. But there were also crypto-specific catalysts. On the same day, President Donald Trump urged Congress to advance what he called a fair version of the Clarity Act during a White House meeting with crypto leaders. The Clarity Act aims to create clearer rules for digital assets. At the same time, SEC Chair Paul Atkins has been working on rules that could ease how certain crypto tokens are offered and clarify how existing securities laws apply to the sector. So the rally was not just a macro accident. It combined a bond market shock with growing institutional hope that US crypto regulation is finally moving in a constructive direction. That matters because regulatory clarity has been the biggest overhang on crypto for years, and any concrete progress changes how large asset managers assess the asset class. Now let's get into why Ethereum's move was so much sharper. At one point on Wednesday, Ethereum rose nearly 19% over 24 hours, compared with Bitcoin's 5 to 6%. That gap tells you something important about market positioning. Ether had been more heavily shorted than Bitcoin, partly because its lower liquidity and larger derivative exposure made it a favorite target for bearish bets. When the Treasury announcement forced traders to cover, the buying pressure was amplified more in Ether than in Bitcoin. The data supports this. On the 21st of August, another $1.06 billion of shorts were liquidated in 24 hours. Bitcoin shorts alone accounted for $789.68 million of those losses. Ether shorts followed with $206.88 million, and XRP added $41.94 million. The pattern here is classic short squeeze mechanics. Traders who sold borrowed coins must buy them back at any price when the market moves against them. That forced buying pushes prices higher, which triggers more liquidations, which forces even more buying. This is why a modest catalyst can turn into an explosive move. Beyond the eye-catching numbers, this week exposed how leveraged the crypto derivatives market had become. When over $1 billion of shorts are liquidated in a single hour, it is a sign that too many traders were positioned in the same direction. That crowding made the market vulnerable to a rapid reversal. The fear and greed index shifted towards greed as buyers gained control, a sharp change from the prolonged consolidation that had defined the previous weeks. But there is a critical distinction here. A squeeze-led rally is not the same as a fundamentals-led rally. Bitfinex analysts summed it up well: squeeze-led rallies usually carry a question mark over whether they hold, because liquidations do the lifting. However, they also noted that this one may have a longer runway because ETF demand, the macro shift and the absence of heavy selling are all present. In other words, the rally may have started with forced buying, but it could transition into genuine spot demand if new buyers step in. That transition is the single most important thing to watch in the coming days. Away from the liquidation cascade, the other headline this week is about stablecoins moving further into the mainstream consumer internet. Elon Musk's X is reportedly exploring the use of Circle's USDC to pay creators on the platform. The plans are still tentative, and X has not confirmed them officially. But the timing is significant. X is phasing out its old revenue-sharing program and replacing it with the original content rewards program. If creators can be paid in USDC, it would give millions of people a reason to hold and use a dollar-pegged digital currency without ever visiting a crypto exchange. This matters because stablecoin adoption has so far been dominated by trading and decentralized finance. A large social platform paying creators in stablecoins would open a new utility path. It also fits X's broader push into financial services. For Circle, the issuer of USDC, it could be a major endorsement. For the crypto market, it signals that stablecoins are becoming payment infrastructure, not just speculative tools. That is a fundamental shift in the long-term narrative. Two other stories from this week show how crypto is colliding with adjacent industries. First, research suggests crypto's next billion users might not be humans at all, but AI agents that pay each other with stablecoins. If artificial intelligence systems need to transact instantly, cheaply, and across borders, stablecoins provide a logical settlement layer. That is still an emerging use case, but it matters because it broadens who or what actually uses blockchain rails. Second, the prediction market platform Kalshi is now off-limits in multiple states, as prediction markets and the CFTC team up for a legal and regulatory battle. While the crypto community often focuses on the SEC, this is a reminder that the Commodity Futures Trading Commission is also shaping the landscape. Prediction markets have grown rapidly, but state-level restrictions and federal oversight are creating a patchwork. For traders, these two stories show that crypto's expansion is not a straight line. The technology is finding new users, but it is also running into new regulatory friction. Both trends can be true at once. So can this rally hold? The honest answer is that it depends on follow-through from spot buyers. As of the 22nd of August, Ether is up about 18% over the last 7 days, while Bitcoin has risen about 8.8%, according to CoinDesk data. Bitcoin's daily percentage changes in August have marked one of the strongest bursts of upside in months. Bitcoin's market cap is now around $1.528 trillion, and Ether's dominance sits at 10.8%, according to CoinGecko. Those are strong numbers, but the real test is whether ETF inflows and institutional demand continue after the short covering ends. The regulatory catalysts also need to become actual rules, not just headlines. If the White House meeting and the SEC's work turn into signed legislation or final guidance, that would give the market a more durable foundation. If not, the risk is that the squeeze fizzles. For now, analysts are watching three things: whether Bitcoin holds above $70,000 on a weekly close, whether Ether can maintain support above $2,100, and whether any X stablecoin announcement becomes official. These are the immediate signals that will separate a genuine trend reversal from a short-lived squeeze. The lesson from this week is not simply that bears were decimated. It is that leverage can exaggerate moves in both directions, and that the most violent rallies often start when sentiment is most one-sided. If you were watching the derivatives market, the warning signs were there: crowded short positioning, falling yields, and a regulatory catalyst all combined into a perfect storm. But the longer-term stories matter more. Stablecoin payments are moving closer to mainstream platforms, AI may create an entirely new user base for crypto rails, and Washington is at least talking about clearer rules. Those are structural shifts, not just liquidation events. As we start the new week on Sunday, the 23rd of August 2026, the sensible approach is to watch the data, not the hype. Keep an eye on spot demand, ETF flows, and official announcements. The market has given bulls the momentum, but it has not yet proven that the move is built on solid ground.